EBITDA is short for earnings before interest, taxes, depreciation and amortization, which means EBITDA is a company's profits excluding these four things. So the only way to properly understand EBITDA is to understand its four components. This is going to be the most comprehensive video on EBITDA from the perspective of an investor. However, if you are a student of accountancy trying to understand the concept for an exam, it may not be much helpful from an academic perspective. This video is not about using numbers and showing how EBITDA and its components are calculated. It's about showing how EBITDA and its components can affect your investments. All investors cannot beat the market because collectively they are the market. As an investor, if you want to beat the market, you cannot think what the market is thinking. Doing so will replicate the market's returns. A contrarian approach has to be adopted to beat the market. However, just doing something different from what others are doing does not guarantee alpha over the index. This video will give you a contrarian approach on EBITDA, and by the end of this video, it will become crystal clear to you whether it is safe or not to use EBITDA as a metric for valuation. And be sure to subscribe so that you don't miss future videos on fundamental analysis. Namaste and welcome to Retail Investing. So let's start with, if you open the balance sheet of a company, you will see the assets and liabilities. On the liabilities side, you can see all the debt the company carries. It includes both long-term debt and the short-term debt. The long-term debt shows up under the non-current liabilities and their interest payments are not due in the next 12 months. The short-term debt, on the other hand, shows up under the current liabilities and their interest payments are due within the next 12 months. The company has to make regular interest payments for these debts out of its earnings or profits. For example, this is the balance sheet of Adani Enterprises Limited as on 31st March 2023. You can see under the non-current liabilities, the long-term debt is 900 crore rupees. And under the current liabilities, the short-term debt can be seen, which is more than 2000 crore rupees. The debt that a company carries are its financial liabilities, but the company can also have financial assets, which can generate interest income for the company. In the balance sheet of Adani Enterprises Limited, under the current assets, it can be seen that the company has given loans of 15,000 crore rupees. This generates a lot of interest income for Adani Enterprises. It is totally possible for a company to earn more in interest than it has to pay out. This is exactly how banks work. The banks borrow money for which they pay interest, and then they lend out the money for which they earn even higher interest. However, a majority of retail and manufacturing businesses have to pay out far more in interest than they can earn. This is a financial cost and has nothing to do with the company's manufacturing or sales. If a company's interest payments are high relative to its operating profits, it could mean that the company is in an extremely competitive industry where heavy capital expenditures are required just to stay competitive. I don't think it is a great idea to invest in such businesses. Very low interest expense is an indication that the company has a competitive advantage, also known as a moat. For example, Procter & Gamble has had interest expenses of around 8% of its operating income, and the company has created massive wealth for its shareholders. On the other hand, American Airlines has had interest expenses of around 92% of its operating income, and without any surprise, it has been a wealth destroyer. The concept of taxes is pretty straightforward. The company reports a pre-tax income, which is called PBT. The applicable corporate tax rate is deducted and you get the net profit. Now there is a very interesting part about it. Many companies report inaccurate earnings. The management may intentionally inflate the profit figures because that would increase the price of the share. In some countries, including America, the tax filings of companies to the tax department are available to the public. Using the tax figures from the tax department, investors can find the real profit figures and then compare it with the profit figures reported by the company. Any discrepancy is a major red flag. To understand depreciation, let's go to the balance sheet once again. Under non-current assets, there is a section called the property, plant and equipment. These assets undergo wear and tear every year. This wearing out is recognized on the income statement as depreciation. The amount of depreciation undergone each year is allocated against the income for that year. Let's understand this with an example. So there is a shoe manufacturing company which has a manufacturing machine which costs 1 crore rupees and has a lifespan of 10 years. This means the company will have to show depreciation for the machine at 10 lakh rupees every year for the next 10 years. And after 10 years, the machine has to be replaced entirely if the company wants to stay in business. This means depreciation is a real cost of doing business and a quite heavy one. So after 10 years, when the company buys a new machine, say at 1.5 crore rupees, there will be changes in the balance sheet. The amount of 1.5 crores will be deducted from the cash and cash equivalents from the balance sheet, and the same 1.5 crores will be added to the property, plant and equipment part under the non-current assets. Then for the next 10 years, a depreciation cost of 15 lakhs every year will be shown on the income statement as expense, and the same amount of 15 lakh will be subtracted every year from the property, plant and equipment section in the balance sheet. It will also affect the cash flow statement. The spending of 1.5 crores for buying the machinery will show up as capital expenditure in the cash flow statement. Companies that have a competitive advantage or a moat usually have lower depreciation costs as percentage of their gross profits. Gross profit is a very simple yet very important concept in investing. You take the total revenues reported by the company and subtract the cost of goods sold from the reported revenues, and you get the gross profit. COGS, or the cost of goods sold, is the cost of raw materials and labor used to make the products. Let's take the example of Coca-Cola for understanding. Coca-Cola's depreciation expense has usually remained around 6% of its gross profits. In contrast to that, General Motors, which operated in a fiercely competitive industry, had depreciation expenses of 22 to 55% of its gross profits. Coca-Cola has been a massive wealth creator, while General Motors has created absolutely no wealth since 2010. If an expense eats up that much of the gross profit, it's not an investment-worthy company, at least for me. In accountancy, depreciation is categorized as a non-cash expense. But according to Mr. Warren Buffett, it is a cash expense, simply because the money is spent first on purchasing the plant and equipment and then shown as depreciation year on year. Now this is some contrarian thinking, but that is how Mr. Warren Buffett has beaten the market for several decades. There is not much to analyze about amortization. It is simply the depreciation of intangible assets. In the balance sheet under non-current assets, you can see the intangible assets. Intangible assets include things like computer software, licenses, trademarks, patents, films, copyrights, and import quotas. The goodwill acquired by a business is an important intangible asset. Mr. Warren Buffett does not consider amortization of goodwill as an expense. So as a retail investor, I would not worry about it. So Mr. Buffett is a very harsh critic of the concept of EBITDA, mainly because it ignores depreciation. According to him, depreciation is the worst kind of expense. Berkshire Hathaway made its fortunes using insurance float. Let me explain the concept of insurance float in very short. Insurance companies collect premiums from people and they don't have to pay back immediately. All the money gets invested for good returns. And these insurance companies have to pay out claims to only 10 to 20% of the people in the future. The difference between the premiums collected and the claims paid is called float. Berkshire Hathaway acquired an insurance company and then used its float to acquire many more companies. That is how Berkshire Hathaway created its fortunes. So depreciation is the reverse of float. The money is laid out much before the company gets any revenues. It is indeed the worst kind of expense, yet EBITDA ignores it. So when a company is valued based on EBITDA, depreciation is not considered as an expense. The investment banking industry has encouraged EBITDA as a good metric for valuation, and that's how they make fortunes, by misleading other investors. Valuing a company based on EBITDA and ignoring depreciation basically means ignoring the capital expenditures. Capital expenditure is something that cannot be ignored because capital expenditures prevent most companies from generating a positive free cash flow, and free cash flow is a foolproof way of valuing a company, especially for retail investors. EBITDA can be a useful metric for valuation for angel investors and venture capitalists who invest in startups because they have special exit strategies which retail investors can never have. So I rest my case against EBITDA. You be the judge and type in the comment section what are your views on EBITDA. Thank you very much for watching the video, and I'll see you in the next one. Have a nice day.